What if everything you thought you knew about silver prices was backwards? What if the biggest price crash in modern metals history wasn't a collapse at all, but a carefully staged illusion designed to make the world sell cheap while one buyer quietly loaded up? For years we were told China dumped billions of ounces, crushed the market, and proved silver had no future. But today we're going to break down why that story doesn't hold up, why the numbers don't add up, and why the real move may already be positioning silver for prices most people still think are impossible. This story starts with fear, because fear is the most powerful weapon in any financial market. In 2023 and 2024, headlines flooded the internet claiming China, through entities linked to the People's Bank of China, had dumped as much as 2.1 billion ounces of silver onto the market. Analysts repeated it, traders panicked, and retail investors sold, believing a supply tsunami had permanently damaged silver's prospects. Prices sank toward the low 20s, briefly touching the $23 range, and the narrative became simple and brutal. China knows something we don't, silver is dead money, and anyone still holding it is about to be crushed. But when you slow down and actually examine the data, the trade flows, the refinery reports, and the historical behavior of the PBOC, cracks start to appear almost immediately. First, let's talk scale, because numbers matter. Global annual silver mine supply is roughly 800 to 850 million ounces per year. Recycling adds another 150 to 200 million ounces in a strong year. That means total annual supply rarely exceeds about 1 billion ounces. Now ask yourself a basic question. If China truly dumped 2.1 billion ounces in a short time frame, where did that metal physically come from, and where did it go? Silver isn't a digital asset. It has weight, volume, storage requirements, shipping manifests, customs declarations, and refinery bottlenecks. Moving even 100 million ounces is a logistical event. Moving over 2 billion ounces would be the equivalent of several years of global supply flooding warehouses, vaults, and exchanges around the world. Yet there was no explosion in visible inventories that matched this claim, no sustained surge in COMEX stocks proportional to such a dump, and no refinery data showing that kind of throughput. The story starts to feel less like reality and more like narrative. This is where understanding how silver pricing actually works becomes critical. The spot price you see quoted every day is not set by physical bars changing hands between governments. It is overwhelmingly driven by futures contracts, paper claims, and leveraged positions on exchanges. For every ounce of silver that exists above ground, there are dozens, sometimes hundreds, of paper ounces traded. This means price can be smashed without a single truck moving a single bar simply by dumping futures contracts during thin trading hours. If you've ever watched silver drop $1 in minutes on no news at all, you've seen this mechanism in action. So when you hear about a dump, the first question should always be whether it was physical or paper. According to information circulating among metals desks and former central bank contacts, the supposed 2.1 billion ounce dump aligns almost perfectly with aggressive paper selling, not physical liquidation. In other words, contracts were sold, prices were pushed down, stops were triggered, sentiment collapsed, but the physical metal largely stayed put. In fact, while the price was falling, something very interesting was happening quietly in the background. Imports of physical silver into China were rising. Premiums in Shanghai remained elevated relative to London. Industrial users were not behaving like buyers who believed silver would keep falling. They were behaving like buyers who saw value. To understand why China would want lower silver prices, you have to look at silver not as a speculative asset, but as a strategic input. Silver is essential for solar panels, electric vehicles, advanced electronics, medical applications, and military technology. China dominates global solar manufacturing, producing the majority of the world's photovoltaic panels. Each panel uses silver paste, and while manufacturers work constantly to thrift and reduce usage, demand continues to rise as installations explode worldwide. When you combine that with electrification, 5G infrastructure, and defense needs, silver becomes less a commodity and more a strategic resource. Lower prices mean lower input costs and the ability to stockpile more for the same amount of currency. Now let's address the idea of the $23 bottom, because bottoms are never obvious in the moment. At around $23, silver was trading near or even below the all-in sustaining cost for many miners. This is a key concept. All-in sustaining cost includes not just digging the metal out of the ground, but paying workers, maintaining equipment, dealing with energy costs, environmental compliance, and corporate overhead. When prices fall below this level for extended periods, supply doesn't increase, IT contracts. Projects get delayed, exploration budgets get cut, and future production is sacrificed. That sets the stage for shortages later, even if demand simply stays flat. When demand rises at the same time supply growth stalls, prices don't just recover, they often overshoot. Historically, silver has a habit of doing exactly that. In the late 1970s, silver went from under $5 to nearly $50 in a matter of years. In the 2000s, it climbed from single digits to almost 50 again by 2011. Each time, the move was driven by a combination of monetary stress, rising industrial demand, and a loss of confidence in paper assets. Today, we have record global debt, persistent inflation pressures, geopolitical fragmentation, and an accelerating transition to green energy that is deeply silver-intensive. The ingredients are there, but the market is distracted by short-term price action and scary headlines. So where does the $180 silver idea come from? And is it fantasy or math? Start with ratios. For much of history, the gold-to-silver ratio hovered around 15 to 1 or 20 to 1. In recent years, it has often been above 80 to 1, sometimes even touching 100 to 1. If gold were to move to, say, $3,000 or $4,000 in a serious monetary reset scenario, and silver merely returned to a more historically normal ratio, you're already talking about silver well above $100. Now add in the fact that silver's industrial demand is structurally stronger than it has ever been, while above-ground investment stockpiles are relatively small compared to gold, and the case for an overshoot becomes stronger, not weaker. Another way to think about it is in terms of market size. The entire silver market is tiny compared to stocks, bonds, or even gold. A relatively small shift in capital allocation can have an outsized impact on price. If even a fraction of institutional money decided it needed silver exposure as a hedge or strategic asset, there simply isn't enough readily available metal at current prices to satisfy that demand without dramatic price increases. This is why silver moves are often violent and emotionally charged. It doesn't glide higher, it explodes, then collapses, then explodes again. Now consider China's long-term behavior. The PBOC rarely telegraphs its true strategy in real time. With gold, China reported no purchases for years, only to later reveal massive accumulation. The same pattern appears to be emerging with silver. Publicly, the narrative suggested dumping and disinterest. Privately, physical buying at depressed prices makes far more sense, especially when you factor in currency diversification away from the dollar and preparation for a more fragmented global trade system. If you wanted to accumulate quietly, you would want weak prices, bearish sentiment, and maximum discouragement among Western investors. This brings us back to that alleged leak and why it matters. The idea isn't that there was some single document stamped secret that proves everything. It's that when you line up trade data, inventory behavior, pricing mechanics, industrial demand trends, and China's historical playbook, the 2.1 billion ounce dump story collapses under its own weight. It starts to look less like a fact and more like a convenient explanation for a price move that benefited a very specific group of buyers. And here's the uncomfortable question every silver investor eventually has to ask themselves: if the strongest hands were really selling, why didn't the physical market break? Why did premiums stay firm? Why did shortages appear intermittently even as prices fell? Why did miners continue to struggle despite supposedly massive oversupply? These contradictions are not random. They are signals that the surface price may not be telling the whole story. At the end of the day, markets are narratives wrapped around numbers, and the winning side is usually the 1T. Hat controls the narrative while positioning against it. If silver really was dumped in size, then the future is bleak and prices will remain suppressed. But if the dump was largely paper, designed to manufacture a bottom and shake out weak holders while strategic buyers accumulated physical metal at historically low prices, then what comes next could shock almost everyone, because the setup looks less like a collapse and more like a coiled spring waiting for the right trigger, because once you accept that prices can be engineered in the short term while fundamentals build pressure underneath, the silver market starts to look very different from the way it's presented on a daily chart. The next layer of this story is understanding how paper leverage, central bank signaling, and industrial demand intersect to create moments where reality and price completely disconnect. This isn't new, and it isn't unique to silver, but silver is one of the few markets small enough that these distortions become extreme. To see why, we need to look closely at how futures markets actually function and why they are so effective at shaping belief, even when they don't reflect physical truth. On major exchanges, a single futures contract represents 5,000 ounces of silver, but almost none of these contracts ever result in delivery. They are rolled, closed, or settled in cash. This allows enormous volumes of silver to trade without any silver moving. When large players sell thousands of company contracts in a short window, especially during low liquidity hours, price drops fast. Algorithms react, technical levels break, and the selling feeds on itself. Retail investors watching charts don't see paper leverage. They see confirmation of fear. This is how a narrative becomes self-reinforcing. The price falls, headlines explain the fall, and the explanation justifies more selling. Now layer China into this mechanism. China doesn't need to dump physical silver to influence price. All it needs is for the market to believe it might. The rumor of a 2.1 billion ounce dump, repeated often enough, becomes psychological supply. Traders price it in long before it ever happens. But here's the critical point. While Western markets fixate on futures pricing, Asia places far more emphasis on physical flow. Shanghai premiums, import volumes, and delivery tightness matter more than the spot quote flashing on a screen in New York or London. And during the period when silver was supposedly being abandoned, those physical indicators were not screaming surplus. In fact, silver imports into China showed resilience, especially for industrial-grade metal. Solar manufacturers continued to secure long-term supply contracts. Electronics producers didn't slow orders. Medical and chemical users didn't behave like buyers expecting cheaper prices ahead. This divergence between paper price weakness and physical stability is often the earliest sign that a bottom is forming. It's like a store where the posted price is falling, but the shelves are still empty. At some point, the sign has to change, or the store runs out of goods entirely. Another overlooked factor is mine supply elasticity, or rather the lack of it. Silver is rarely mined alone. Roughly 70% of global silver production comes as a byproduct of mining other metals like copper, lead, zinc, and gold. That means silver supply doesn't respond quickly to silver prices. If silver demand spikes, miners can't just flip a switch and produce more. They are constrained by the economics of the primary metal they are targeting. This makes silver uniquely vulnerable to demand shocks. When demand rises faster than supply, price has to do the work. During the price weakness around the low 20s, miners were already under pressure. Energy costs were high, labor costs were rising, and capital markets were less friendly to mining projects. Exploration budgets were cut aggressively. This doesn't reduce supply tomorrow, but it reduces supply 2, 3, 5 years down the line. When people talk about future shortages, this is what they mean. It's not that the world suddenly runs out of silver. It's that new supply fails to keep up with incremental demand growth, and inventories get drawn down quietly until there's nothing left to cushion the system. This is where the idea of strategic accumulation becomes powerful. If you are a nation planning decades ahead, you don't want to compete for scarce resources during a panic. You want to buy when nobody else wants them. You want to lock in supply when miners are desperate for buyers and investors are bored or scared. Lower prices are not a threat in that context, they are an opportunity. And unlike gold, silver has the advantage of being both a monetary metal and an industrial necessity. It serves two masters, which means demand doesn't disappear even when investor sentiment does. Think about silver like oil in the early 2000s. Prices were low, investment was minimal, and supply growth lagged demand. Then global growth accelerated, inventories tightened, and prices didn't just rise, they exploded. Few people believed triple-digit oil was possible until it happened. Silver has a similar psychological barrier. People anchor to recent highs around $50 and assume anything beyond that is unrealistic. But markets don't care about anchors. They care about balance, and when balance breaks, price seeks a new level that restores it. Another crucial piece of the puzzle is monetary confidence. Silver has always thrived during periods when trust in currencies erodes. Today, global debt levels are historically extreme. Governments rely on deficit spending not as a temporary measure, but as a permanent policy tool. Central banks talk about fighting inflation, but structurally, they need inflation to manage debt burdens. This creates a slow erosion of purchasing power that pushes savers to look for alternatives. Gold gets most of the attention, but silver often follows with a lag, then outperforms in percentage terms. If gold moves because central banks are buying and currencies are weakening, silver moves because everyone suddenly realizes it's both money and material. That realization doesn't happen gradually. It happens in waves, usually triggered by some event that exposes the fragility of the system. It could be a financial crisis, a geopolitical shock, a supply chain breakdown, or a loss of confidence in government bonds. When that trigger hits, silver doesn't ask politely whether it's allowed to rise. It gaps higher because there simply isn't enough readily available metal to meet demand at the old price. Now revisit the $180 figure with this framework. It sounds extreme only if you assume today's pricing structure remains intact. But if paper leverage unwinds, if physical demand overwhelms available supply, and if silver reasserts itself as a strategic asset rather than a speculative toy, then previous ceilings become irrelevant. In the 1970s, $50 seemed absurd until it wasn't. In 2011, silver went from under 10 to nearly 50% in less than a decade. A move from the low 20s to triple digits over a longer cycle is not unprecedented behavior, it's consistent behavior scaled to modern conditions. The key takeaway so far is not that silver must go to $180, but that the forces capable of driving it there are already visible. The alleged Chinese dump fits perfectly into a pattern of price suppression followed by accumulation. The paper market provided the mechani. S&M, the narrative provided the cover, and fear provided the fuel. Meanwhile, the physical market told a quieter, more honest story to anyone willing to listen. As we move forward, the question shifts from whether the past dump was real to what happens if the market finally calls the bluff. What happens when holders of paper silver ask for delivery in greater numbers? What happens when industrial users compete with investors for the same limited pool of metal? What happens when price is forced to reflect physical reality instead of leveraged claims? Those questions lead directly into the next phase of this story. Because the endgame for silver is not about charts or headlines. It's about trust, availability, and timing. And that brings us to what could trigger the next major move and why the window to position may be far smaller than most people think right now.